Now, the price of oil has climbed to its highest in almost a decade. That's due to persistent fears of the global economy losing access to crude from Russia, one of the largest exporters of the commodity. The international benchmark Brent has risen more than 3.5% to reach $116 a barrel. The last time oil was that expensive was in August 2013. Since the start of this year, the cost of oil has risen more than 50% due to rising demand and the tightness in supplies that are being exacerbated by Russia's attack on its neighbor. And over the past 12 months, prices have almost doubled. Now for more, let's go to David Madden. He's a market analyst at Equiti Capital in London. David, welcome back to the program. Now, we haven't seen sanctions on Russia's energy sector yet, save for a few exceptions, but we are seeing some traders, private sector, voluntarily avoiding Russian export. What does that do to supply levels in the market right now?
Well, it really puts a real-life dampener on actually supply levels, because a lot of the actions by speculators and traders in the last few days and the past few weeks has been that sanctions are either going to come on the Russian energy sector, or at the very least there could be some sort of disruption whereby there is a shortage. Now we're seeing some buyers, as you mentioned, voluntarily not purchase products from Russia. That's just basically leaves quite a large gap in the market in terms of supply. Other energy producers won't be able to just simply switch on the light, as it were, and ramp up their output as a way of actually bringing more oil to the market, as a way of selling it on to try and offset the essential shortfall that has been created by buyers not willing to trade Russia. So this situation is in relation to oil production. It takes weeks or even months to actually kind of rectify. So we're not going to be having any kind of normal operations in the oil market in terms of output and supply anytime soon. So with that, we're likely to see oil and gas prices at elevated levels. And if the way things are going, given the conflict, it looks like energy prices are more likely to get higher in the medium term than they are lower.
David, obviously this is a balancing act between producers and consumers. At what point will oil prices be too high that it depresses demand from households and businesses?
It's difficult to say, but as we approach the $150 a barrel per region, that's likely to put that much more pressure on households. Just considering that even before this conflict took place, inflation in the Eurozone was already at a record high. Here in the UK, inflation was already at its highest level since the early 1990s. And over in the US, inflation is running at 7.5%, its highest level in 40 years. So when you have a situation where the cost of living was already at either multi-decade highs or all-time highs, and the momentum was with rising prices, then you throw into the mix a shock to the energy market, it really is going to put more and more pressure on consumers. Now, from a political point of view, in the last 24, 48 hours, we've heard from OPEC Plus. They seemingly have no major desire to change their existing production plans. Should we see a prolonged period of high oil prices, I wouldn't be surprised if we have various Western governments calling on oil-producing nations in the Middle East to step up and ramp up their output as a way of actually taking some of the heat out of the market. But as you've seen in the past day or two, for the time being, OPEC Plus has got no major desire to change its output. So I think, sadly, high costs are with us for the short to medium term.
All right. David Madden, market analyst at Equiti Capital. Thank you for joining us with your analysis.